Welcome to Volatility 411 for Equity Armor Investments. I'm Joe Teagate. Let's jump right into it. We have the VIX currently at 17 and 3/4, and it settled for the month at 17.12. Now remember, this is a very low level for the VIX. Right now, the S&P 500 is also on a relative high spot for that. So a lot of people will say this is great. We are past all of our worries and the market's just going to race on to new highs. Well, the flip side of that is maybe there is the case to be made that the market is complacent here. We do have a lot of potential market movers up ahead, not the least of which is the debt ceiling fight. Now, on that front, the VIX might be saying, hey, we've seen this movie before. We know they're going to come up with a deal. Why should we bother with raising volatility only to lower it as soon as the deal gets made? And yeah, that might be the case, but the flip side is, whoa, we are set up for a big rise in volatility should we get closer to that deal, and there is no deal to be made. So we're certainly watching out on that front as well. And just in general, we are at levels where volatility has not been since 2021. Remember, that is when the market went on a 20% decline. We also are starting to see some warning signs on the economy. We're seeing initial jobless claims start to rise. Now, could it be that they will fall back off and we won't see any job losses? That's possible, but historically, this is a time when you expect that to happen with the Fed at the end of their rate hike cycle, and you should expect to see job losses and the unemployment rate start to rise, and you should expect to see the jobless claims continue to rise. And when that happens, again, we should expect to see volatility on the rise. All this is going back to my contrarian approach with volatility. When volatility is high, I expect it to come lower. When volatility is low, I expect it to come back higher. For Equity Armor Investments, I'm Joe Teagate.